Yeah, I guess I'll just start and kick it off. Hi everyone. I'm Chris Engel. I am in investor relations with Disrupt Equity. We're bringing on Brian Bingham, who performs cost segregation analysis for us, and he's going to add some context with that, and he's going to talk about the benefits of it. I'm going to leave it to you, Brian.
Well, beautiful. So I'm not sure how many people we have on or what type of we have investors, we have GPs, LPs, you name it. But I guess the question is how familiar everybody is with the different glossary terms, like what LPGP actually means. So let me ask you that. Do I need to, explain it without abbreviations? Would that be the best way to go? So let me go ahead and share my screen sooner or later.
All right, I just approved it, so it should.
Got it.
Yeah,
Okay, you tell me, can you see my screen?
now I can.
Okay, perfect. All right, guys. So really, I'm going to go over kind of the details of the cost segregation or depreciation, accelerated depreciation, bonus depreciation. Essentially, one of the best known now, very well known, and some ways best kept secret of tax benefits, tax strategies in commercial real estate. So apparently, that's my new brand now, the Cost Seg Cowboy. I am in Texas. I do own a cowboy hat. I do own a pair of boots. I'm 6'4" and about 280 pounds, so I don't ride horses. That's just for the benefit of the horses. I hope that's okay. So let's just jump into it. Make sure I've got it right. Okay. And the slide changed, correct? You can still see the slides?
Perfect.
Perfect. Okay. I always want to double check that. All right. So, and forgive me, everybody, I love using metaphors and whenever I talk about this because it is one of the best ways that I learned, when I really started getting into this. And it's kind of a really good way to visualize how it's going to help you and benefit you on your tax filings. So essentially, what's depreciation, right? Depreciation, you got to look at it as a wear and tear. Whenever you buy a property, a commercial, residential, non-residential, whatever, the income producing property, you have allocated to you depreciation. Depreciation essentially is any asset, physical asset, everything from the flooring, what's inside the building, what's outside the building, to the roof. Everything has a cost or a replacement cost associated to it. So depreciation is a reduction in the value of the asset over time. Whenever you buy a property, you have to take two things out of it. One, you have to take you take the total purchase price, you take land value off the table. All right, so land is not depreciable. Land, if a tornado came and knocked the building that it sits on that land, what's left? Just the land, correct? So that is a non-depreciable asset you take off the table. So if you were to take a purchase price minus land, that leaves you with the number two, your depreciable basis. That basis is all the depreciation or tax losses you get on that property over the course of 30 to 40 years. There are two types of classes when it comes to depreciation. First one is residential, which is what we're going to primarily talk about on this webinar. And that gives you 27.5 years of total depreciation, meaning you take that depreciable basis, remember, purchase price minus land value, and you divide it by 27.5. That's how much depreciation you get every single year. So let me give you an example. So this is what we call straight line depreciation. Before I go further, I need everybody to know that when it comes to depreciation, you basically have three types of depreciation available to you whenever you get into the commercial real estate industry. Number one is straight line depreciation, which is this right here. The second one is cost segregation, which is kind of the main topic of this. And the third one is bonus depreciation, the big, hot, beautiful piece of commercial real estate. So the first one, straight line depreciation. So, for instance, if you're looking at the example I've given you, you buy a property for $1 million. Take maybe 15% of that $1 million is land value. So you take $150,000 off the table. That leaves you $850,000 of depreciable basis. Now, if you took that basis and did the straight line depreciation, you take 850,000 divided by 27.5. That gives you $30,909 of depreciation each year, right? Which sounds like a lot, right? Let me ask you this. Does it still sound like a lot if you have maybe 10, 20, 30 investors involved? Everybody gets a piece of that. So that 30,909 gets cut down amongst multiple people. So with that amount of depreciation that's being lowered down, when it comes to how much income tax can it offset, very minimal. In some cases, straight line depreciation, you have to pay your income taxes at the end of the year because it just doesn't cover it. So, when I talk about assets and what's being depreciated, everybody's thinking this is too much. My mind is spaghetti right now. It's going in many different directions, all twirled together. So let me kind of break it down. Like, what does depreciation ultimately take? And that's what we consider asset classes. So when it comes to multifamily or residential properties, you really have three different types of asset classes. First one is 5-year property or tangible. This is another way of looking at it is it's things that are on the inside of the building, but not part of the structure. Things like flooring, cabinetry, appliances, ceiling fans, decorative lighting, window blinds, all these things have a 5-year life expectancy, so to speak. So what that means is instead of getting that 5-year assets averaged in over 27 and a half years, we want to move it to where it's supposed to be years 1 through 5 because it's only depreciates over 5 years. It has a life expectancy of 5 years. Why wait 30 years for it when I can get it the first 5 years? All right. The second one is 15-year property or land improvements. And you can also say it's exterior land improvements. And these are things like what's added to the property to function, but not necessarily part of the structure again, and added on top of the land. These are things like driveways, sidewalks, signage, if you have a monument sign outside, concrete curbing, landscaping, even though it's in the dirt, it was added to the land as part of the business or part of the curb appeal of the property. That goes into the 15-year property. Same concept. Instead of waiting 27 and a half years for it, we're moving it out and putting it into years 1 through 15. So the final one, I didn't necessarily need to do a slide for, and that's your structural or your non-tangible assets, things like your framing, electric or plumbing that actually make the property habitable, foundation, windows, walls, roof. So everything that makes that property able to be habitable goes into the 27 and a half year category. And in the coming minutes, I'm going to explain why the 5, 15, and 27 and a half year actually plays a pivotal role in the different types of cost segregation and bonus depreciation. All right, I just wanted to get everybody's mindset on what we're talking about when it comes to assets and depreciation. So then we get to the next step up from straight line depreciation, which is cost segregation. So exactly what is it is what I was explaining a little bit earlier. You're essentially taking everything instead of being straight line depreciated and pulling it out of the next 30 years and putting it into its correct bucket of life expectancy. 5-year property goes into years 1 through 5. 15-year property goes into 1 through 15. 27 and a half stays consistent, 1 through 27 and a half. By doing that, you're reclassifying all the assets internally and providing yourself 2 or 3 times more the paper losses to utilize in your tax filing. So how it's going to be done is essentially what I do, and that's a engineered based cost segregation study. So to give you an idea of what it actually looks like side by side, What I have here is, oh, well, I got the colors mixed up. Sorry. I did some of this morning. So I got the colors mixed up, but essentially the green is actually straight line depreciation. As you can see, it's going consistent. Every single year you get the same exact amount, no matter how much improvements you add, no matter what you're appreciating it or what the market is telling you to do. You get the same amount of depreciation every single year in green. The blue is cost segregation. Now, if you can see the from years 7 until 28, how it's a little bit lower than the actual straight line depreciation, the green, that's because what we're doing is we're pulling all that 5 and 15 year asset out of future years and bringing it forward. So you can see years 1 through 6 specifically, the blue, you are getting double or triple the amount of depreciation. Now, why does that matter? Well, one, it offsets all of your, personal income tax liabilities from your investment or ownership of that property. So that's nice. You don't have to pay taxes on money you're making from it. That's a plus. But also, it pushes forward any depreciation not used or next year's depreciation and adds them together and essentially could double or even add a triple amount on top of what you're already going to get. So that's the beautiful thing about depreciation. It doesn't expire. You're getting it. It's just a matter of how much you get and when. All right? Are you with me so far? Perfect. All right. So let's get to the fun part. Let's talk about bonus depreciation. Bonus depreciation, super hot. It's been talked about since 2017. It made the news. It's changed the market, changed the economy. It did everything for real estate. And then obviously 4 years later, 5 years later, it started to dwindle down. And then everybody, the real estate market, everything changed. But lo and behold, earlier this year in July, it changed again. And now it's changed for the much better. So bonus depreciation essentially is taking into any asset class from the property you're purchasing or placing into service for new developments, and you are taking anything under a 20-year life expectancy in the first year, meaning any 5 year property, any 15-year property, you're taking all of that in the first year of ownership that you place that property into service. So what that basically is doing is it's 10xing. It's cost seg on steroids, guys, for your property. And one of the best things about it that I love most about it, even on my personal investments, is that it allows you to use what you need to cover everything, offset all of your income tax liability. Whatever's left over carries forward. It rolls over to next year, and you get a little extra added every single year that you keep rolling it over. So it's a beautiful concept. It's essentially just giving you loss after loss after loss. So as what we're going to kind of talk about is the timelines as well. So one big thing when it comes to the IRS and commercial real estate depreciation in general, not necessarily about the income or about the purchase, it's about the timeline. All right. And that's very specific when it comes to bonus depreciation. So, oh, before I start, very simple. Here it is. Bonus depreciation. Same concept as cost segregation, but you are taking all the 5, all the 15 year and putting it into year one. So just to give you an example. All right, but when it comes to dates, when it comes to timelines, that's the main thing that everybody needs to know about. So back in 2017, actually September 2017, the Tax Cuts and Jobs Act of 2017 was put into play. What that basically said was bonus depreciation, you would be able to get 100% of bonus depreciation for certain dates. Now, these dates are basically from September 2017 until the end of 2022. So December 31st, 2022. You can get 100% bonus depreciation. Then, after that, it started to cut down 20% every single year. So if you bought and placed a property into service in 2023, you were only able to get a max of 80% bonus depreciation. 2020 last year, 2024, 60%. And then until the One Big Beautiful Bill Act passed in July, 2025 was slated for only a max of 40% bonus depreciation available. Now, that's not saying that you get that 60% bonus for a property you bought and placed in service in 2024 and it's a use it or lose it. It's basically saying you get all that depreciation, but you can only use up to 60%. The remaining 40% difference is actually spread out and rolled over year over year over year. So you're still getting it. You're just not getting it the first year, all of it. All right. Now, what this is basically telling me is everything has a window of eligibility. All right. Now, before I talk about that and how to strategize with that and look onto some properties that you guys might have owned for the last few years, let me show you what the new One Big Beautiful Bill Act, which I'm going to just say OBBBA, make it quick and easy. So the OBBBA was put into play in July 2025. But what it did was it essentially said that 100% bonus depreciation is going to be reinstituted indefinitely, which is a fantastic word, starting January 19, 2025. Now, the key why they put that specific date in is because, and I'm going to go back one slide, these calendar dates have to stay the same, mainly because the IRS did not want to see 500 million tax amendments being put into play for 2024, 2023. They basically wanted to start everything 2025, to restart everything. So what that essentially means is that if you did buy oh, I'm sorry, I went forward too fast. If you did buy and place a property into service anytime past January 1st, 2023 until January 19th, 2025, it's going to show up as the window of eligibility for either 80%, 60%, or 40%. And I say 40% because it's right here, that weird window of 2 to 3 weeks of time. Um, there is many things to note on why these dates have a very, very high meaning for real estate owners. Is because if you purchased a property, placed it into service during that window right there, that 40% election, you can only get 40% bonus depreciation. Here's the other side. If you guys are doing new construction, a new development, and you're placing into service, um, it's the tax law states that if you drew up the contract, you drew up the draws for that new development, anytime before January 2000 or January 19th, 2025, then it's only eligible for 40%. It's that point, it's not available at the 100% level, even if it's placed into service during this new window. It's all about when it was drawn. All right. And unfortunately, the same goes for acquisitions. If you guys are purchased a property, let's say you put it under contract December 1st, 2024, and it was placed into service. You closed on it and you placed it into service February 1st of this year, 2025. Because of when the property was actually placed, or I'm sorry, under contract, that's the date that you're going to have to file with the 40% election. And it gets very complicated. I'm happy to walk anybody through the details or just give you a recommendation on what you would expect to see. I'll have my contact info at the end of this slide. All right. What are the benefits? Well, damn, it reduces your tax liability, guys. By not paying taxes to the government, what do you get? More cash flow. All right. This whole scenario is the time value of money. You are essentially getting the same amount of depreciation you would have gotten on a straight line, but you're getting it now instead of waiting 30 years for it. I'm not entirely sure. I could probably count on two hands, maybe even one, how many of my clients actually plan on keeping a property over 27 and a half years that they're investing on. So the concept is why not take that depreciation now and worry about nothing later? Now, when is the absolute best time to do a cost seg study? Any friggin' time. All right. When you acquire a property, get a cost seg done because it's going to it's going to pull all the assets out of that acquisition and provide it to your tax return, your investors' tax returns, everything. If you guys are developing a property, it's all based on when it's placed into service, when you get the CO or the certificate of occupancy, or even a TCO. All right. The concept is whenever you place it into service, you should have a cost seg done on that because it's going to immediately give you enough losses. Even if the property is operating in a negative capacity for income, you still have a massive amount of losses to carry forward. You want to take advantage of that and right before all that income starts flowing. If this is the first time anybody's heard of cost segregation and you've owned properties for multiple years, I mean, this cost seg has been around since 1987. Bonus depreciation has been around since 2017. We can go as far back as 1987. Now, is it worth it? Probably not that far back. There's probably not much depreciation left to work with. But you never know how much you can pull from a property based on when you place it into service. So always get a look, get an estimate, get an idea of what you can pull from that property, even if you've owned it for multiple years. All right, the benefits far outweigh the costs. If you purchased property, you had cost seg done, you said you're good to go, you have that property and you've added, let's say, 1 million or 2 million, even 10 million of improvements or renovations, or just gut rehabbed it. Well, you can do a new cost seg study on it, on the exact amount that you improved upon. This is one of those fun concepts I like to call refill in the bucket. Because what you're doing is you can get cost segregation done on the acquisition, right? Immediately take those losses, take a massive amount of losses up front, distribute it out to everybody involved in that entity that owns the property. Then you start adding renovations, right? You can start tearing things out and throwing it away because you've already captured it on your original cost seg study. But when you are adding things in, just keep note, keep spreadsheet, keep invoice sheets, keep whatever you can, the record of what you're adding and how much it costs to add it, and then wait a calendar year. So, because what you're going to do is you're going to immediately take a secondary cost segregation on the improvements added and refill the losses that everybody used on their previous tax return from the acquisition. I know that's a lot of words, but you got to look at the timeline strategy of this. Buy a property, get cost seg done, start renovating. The next year, take those renovations, get a cost seg on just the renovations only, refill your original cost seg bucket. Do the same thing the next year, refill it. Just keep refilling. Guys, there's nothing like having a stockpile of losses to wave in the government's face and say, no, I'm not paying those. I got enough losses. We're good. All right. So I'm going to give you a little example on how you can really break it down or give it a better figure. If there's investors or LPs, limited passive investors on this deal, then this is a good way of looking at how it's going to benefit you. All right. So I took an example of a client that I actually did the cost seg study for a few weeks back. I try to update this thing as much as possible. All right. So if you're going from left to right, all right, you got the price, $10 million. This was a multifamily property. All right. I believe it was actually down in just north of Houston. So $10 million property. We pulled county appraisal records, just plain appraisal records, everything we could find. We found the land value of that property was 10%, right? So $10 million purchase minus 10% land allocation, that gives you a $9 million basis. If you did straight line depreciation, that's 9 million divided by 27.5. That's it. What we found was when you break it down on a per investor level, you take that $9 million basis, with a down payment or a rate equity amount needed from the investors of 4 million based on whatever loan, whatever lending concept they have. $100,000 investment in that deal will get that investor 2.5% ownership of the entity buying the property. From that 2.5% ownership, their $100,000 investment nets them $72,000 and more in year one depreciation. So every investor that put 100K in this deal, this one deal, they immediately got $72,000 back in losses for to use on their 2025 tax return. Now, that's pretty nice. But that also is not all they get. So that 72K they get immediately for 2025. Now, over the next 4 or 5 years, they still get depreciation. They get about 5,500 at the minimum of depreciation added to that 72 every single year. Now, usually the formula for a multifamily syndication investment is buy, hold, sell around year 5 or 6. So this formula is based around that concept. For that same $100,000 they originally invested, when they walk out from that deal, when it goes full circle, they will have gotten over $100,000 of depreciation losses. So how does that work? How did somebody invest 100K and get over 100K in losses over 5 or 6 years? It's all based on the calculated value of the lending, the cost segregation report, land value, etc. It's not based on the raise amount. It's based on the total purchase price and your entity ownership. So, and again, guys, I've got this. I can do this anytime somebody needs me to. It's you give me numbers, I'll break it down for you. I can give you anything you need on this. I love the finite answers to cost segregation. All right. And then just to give you an example here, oh, my screen. There we go. So this is just another case study. A recent client I had that bought a multifamily property in Georgia, bought it for $18.25 million. Now, if they did straight line depreciation, they're essentially going to get $642,000 annually. Now, one thing you have to note when it comes to the dates, and remember I told you dates are more important when it comes to the IRS. This property was bought almost halfway through the year and placed into service halfway through the year. So they didn't get that full 642,000. They got from June until December, not January to December. So they only got for straight line depreciation year one tax benefit $348,000. So $348,000, but sounds like a lot, but he had about 28 investors on this deal. So 348K divided by 28 and more based on GP ownership and everything, that doesn't match much. And they were already in the green. So it's a toss up. So what I did was I talked to him and I explained to him. He gave me a shot on this deal to do cost segregation. Here's what I found. We found that 18.25 million, the land allocation was ridiculous. There was only 3% value, and we double and triple checked it. 3% land value. So that left us a basis of $17.68 million, which is fantastic. We also found that 36% of that property was able to be segregated to 5 and 15 year category. So your 5 year category, 26%, 4.5 million. 15 year category, 10%, 1.8 million. The bulk of it, the remainder, what went into the structural component, which was about 11.2 million. Now, when you put all those together and you run it for bonus depreciation, that client got 6.6 million over $6.6 million in depreciation year one. So the key is what looks better? 348,000, 6.6 million. I'd say it was a rhetorical question, guys. So the concept that's the power of it. The concept is you're taking this property, you're getting the same depreciation you were getting anyway, and you're simply reclassifying, moving it, legally moving it to where it needs to be or should be anyway, and take full advantage of it. And then I always put this in here just to kind of prove my point. If anybody wants to look this up, there is the IRS put out the IRS cost segregation audit techniques guide. This is just a kind of a simple checklist of what everything is involved. I only put this on there because it's a great read. You know, puts you to sleep in 5 minutes. You put it by your bedside. But really, it's showing everybody that there is a very specific way of doing this. This is not a DIY kind of thing. This is very technical based and needs to be engineer based. Even I would even recommend not doing more on the engineer side, not on just the CPA side. Love CPAs to death, work with hundreds of them. But this has to be done very detailed when it comes to measurements, quantities, linear footage, square footage, glossary terms of replacement costs. I mean, it is very specific and has to be engineer based. All right. From that, it goes to this fat face. Well, actually, it wasn't fat face. I got the fat face now. Back then, it was not. But guys, the whole deal with this is I do this on my own personal investments as well. There is nothing like having so many losses to be able to utilize. There are things that it pushes you for, there are things that it pushes against. That's why you just got to talk to an expert, talk to somebody that knows all about the ins and outs. And you find that person, then I got you covered. That's all I got for you. I went really fast, sorry, but I wanted to leave tons of room for questions.
Thank you very much, Brian. A lot of information there, and any questions that anyone has, you can put it in the chat or the Q&A, and Brian will go ahead and answer them.
All right, so I'm gonna have to put, oh, well, hold on, let me see. Yeah, I can put the chat on the side. All right, anything. I'm gonna do everyone. See, is there anybody on here? There's no way that after all of that, that fast, that you're not gonna have some question to ask. But I mean, guys, I left a lot of things on just on the edge.
Here we go. We have one in the Q&A. What's the minimum property value that is recommended for a cost seg to be beneficial?
So I used to say anything works, but that's not true anymore. What's worth it, right? What I have seen people actually that works for them to the case where they do not have to pay a dime in taxes, no matter how small. I'd say $250,000 purchase. All right, so that $250,000, even though you're probably going to take some land out of that, it's still going to leave you with a nice chunk of bonus depreciation that you can utilize. But remember, guys, it's not about how much it costs. Is it even worth it? One, estimates, there's no charge to do projections or estimates for cost segregation, right? You should always get one done anyways. That should be technically part of your underwriting. Even though it doesn't affect underwriting, it should still be there so you can have it as a something in your back pocket to utilize. But whenever you want to think about like how much can this actually get me, the idea is not about how much you're going to get. Is it worth it? It's about does it put a dent or eliminate those tax income liabilities? So long-winded one answer for one question.
Yeah, and we have a good bit now in the chat. How is land allocation determined? I saw a wide range of 3 to 15%.
Yeah. Oh, yeah. So land value is probably one of the most fickle things. And it's, of course, detrimental to determining how much depreciation you can ultimately get. Rule of thumb for everybody, the lower the land value, the higher the depreciation you get. I have found that the best course of action is your county appraisal property search. Everything is online nowadays, but there are some counties in the country that's very out of date, and they actually don't update that property for multiple years. The key is even if you find your property on a county appraisal site and you're buying it today, let's just give an example. You're buying that property today. You find it on county, but it hasn't been updated since 2023. You don't take that amount that they're appraising it for in 2023. Instead, you're doing a calculated value. So you're taking what it was in 2023 and dividing it by the total, including improvements on that deal. And you're taking that percentage and applying that percentage to your current purchase. So, and that could be anything from 3% to 5%, or even I've seen as high as 72%. But I will tell you, the national average of land value is 15%, national average, with the exception of New York and California. That actually is the average of those is 25%. But if it's higher than 15%, then you want to do a double check, all right, to make sure you can find the lowest documented amount of land value. That will give you the most appreciation.
Thank you for that. And can these losses offset W-2 income?
So they can with certain exceptions. So whenever there's something that's called a active real estate professional status. I myself am an active real estate professional. In order to meet that classification, you have to meet basically two categories. The first one, and it's the most highly scrutinized one by the IRS, you need to have 750 hours per calendar year involving real estate meaning trading, closing, transactions, um, maintenance, management, things like to that nature. The second category is 50% or more of your business is related to real estate. And that could be anything from brokerage to maintenance, management, everything. Just like I said, even if you went and you had a W-2 job during the day, it had nothing to do with real estate, you go home at night and you do underwriting or manage it or arrange maintenance or update your Airbnb listing, whatever type of property it is, as long as you're doing it 2 to 3 hours a night, 2 to 3 hours times 365, that would definitely get you your 750 hours. But the reason why that active real estate professional status is important is because by qualifying, you can now make every single loss that you have active. Right now, cost segregation depreciation is considered passive losses. Passive losses can only offset passive income. But if you are a real estate professional status, everything becomes active. There's no longer a difference between passive and active. Everything is active. Now those active losses can offset W-2, 1099, capital gains, stock gains, you name it. It can offset it. So that's the way that it can offset your W-9, W-2.
Okay. And the next question from Kevin, can you do this for my rentals in Hawaii? That value at $1 million, we did $200,000 of rehab after acquisition.
Oh, beautiful. Absolutely. Absolutely. Guys, we can do all 50 states. Technically, you can do it anywhere in the world, but you see, the depreciation is based off U.S. federal income tax. So because it's U.S. federal income tax, if I was to now I haven't, but if I bought a property in London, England, and it was an Airbnb property, all the money made from that will actually come to me and flow through into my U.S. bank. U.S. federal income taxes I got to pay. Now I can cost seg that property and take the depreciation and utilize. So yeah, absolutely. Hawaii. I actually have done many properties in Hawaii.
Yeah. And I can make the introduction to Kevin for you as well. I'll be in an email after this.
Absolutely.
Uh, but the next question is, are there any cap or income limits for who can take advantage of bonus depreciation?
Um, any cap or income that can take advantage, or I mean, everybody can take advantage of it. There are some, different concepts, not necessarily like who, but what type of investments that you can take. So if you're investing in a 401k or a self-directed IRA, then you're that's basically a tax-free investment apparatus. I mean, you're investing through a third party, which means it doesn't touch you. It doesn't touch your bank account, doesn't go to or from you, anything like that. Then you're able, you don't have taxes to pay on it. So that depreciation's still provided, but it's might not benefit you as much as somebody else. So, but yeah, no, anybody can do it. There's there are some limitations. For instance, if you are investing through an S corp, or a C corp even, the C corp would actually it might not benefit you as high as doing it through an LLC. LLC is always a pass-through entity, but that would be you might actually experience more of a double taxation, and you wouldn't see as much benefit, or you can't carry forward the benefit you're receiving each year. So yeah, that's a good question.
Okay, and if a property was acquired in 2021, but placed into service in 2025, how does that impact depreciation?
When you say it was placed in service, is that sort of like one of those either I bought the land and I did a brand new construction for 4 years and then placed it in service? Or is it a bought a property, uh, gut renovated it and placed it into service 4 years later? Or it could even be if it's an opportunity zone. So that's an open-ended question. But essentially, it's not based on when you purchased it ever. It's based on when it's placed into service. And here's a great example that's probably going to open some people's, eyes a little bit more and or ears, whatever. But if you guys lived in a house, that was your permanent residence, all right, and then made some money, decided to buy another house, but keep your current house and turn it into a rental. Let's say you could have lived in there for 50 years and decided today that you wanted to turn it into a rental. So what that's going to do is you're not basing it off of when you originally bought it, you're basing it off of when it was placed into service. So if I was to place my personal property into service now as a rental today, then my depreciation that I would get is based on how much I paid for it, plus any improvements added to combined if needed. And starting today, I'd get depreciation for 2025.
Okay, and that was the scenario investor typed into the chat. And the last question that I'm seeing is, can we get a copy of the deck?
Oh, absolutely. I made this thing very short so I can literally just send it out to anybody that requests it. So guys, my email right here, shoot me an email, just say, "Hey Brian, saw your presentation. I think your picture looks better than you, whatever." It's fine. But no, just say, "Hey, can you send me a copy of the link?" I'm happy or of the deck. I'm happy to do it.
Okay. Does anyone else have any other questions?
No, I will always say I do presentations on stage. This is actually one of maybe 13 or 14 different presentations I give. But I always find that people have the absolute best questions ever when they're 10 minutes later or an hour later.
Well, we just had a question come in.
There it is.
Could a cost seg be done for a single rental unit that was purchased 15 years ago that is part of a larger condo?
Yes. I won't even go into detail on that. Yes, you can. Yeah. I mean, hell, I can do, if I was renting out a single room in my house, I could do cost seg on that single room, right? Plus a percentage of the common areas that is accessible by that room. You can cost seg, you can be creative with it. That's what tax strategies are, being creative with your tax filing to it's offset as much as humanly possible.
Awesome. Does anyone else have any other questions? Well, Brian, thank you very much for joining us today. I will, send an email to you shortly after introducing you to Kevin and everyone. Thank you for joining us. And if you do want to take advantage of cost segregation, reach out to Brian. And we are currently working on a deal as well that will get you between 60 and 80% bonus depreciation.
It's a good
So
deal. It's a really good deal.
yeah. So if there is interest there, reach out to invest at disruptequity.com.
All right. Thanks, guys. Appreciate it.
All right. Thank you all.